Hello, welcome again to the episode of the Let People Prosper series. My name is Dr. Vance, Ginn. I hope you're having a prosperous day. Well, today we have somebody who knows a lot about free banking, money, Bitcoin, gold, just a number of things. And he's got a great book out called Better Money that you should check out. And it's none other than Dr. Larry White. Larry, welcome to the Let People Prosper show.
Thanks, Vance. Good to be here.
Well, great. It's really a pleasure to have you on the show. I've been reading your work for a long time, so I look forward to our conversation today. Like I do with all my guests, let me go ahead and read your bio just for the audience so they'll know who you are as we're talking here today. Larry White specializes in the theory and history of banking and money. He previously taught at New York University, the University of Georgia, the University of Missouri, St. Louis. Professor White is the author of Better Money, The Clash of Economic Ideas, and Competition and Currency. His articles on monetary theory and banking history have appeared in the American Economic Review, the Journal of Economic Literature, and many others. In 2014, he received the Adam Smith Award of the Association for Private Enterprise Education. He has been a visiting research fellow at the American Institute for Economic Research, a visiting lecturer at the Swiss National Bank, and a visiting scholar at the Federal Reserve Bank of Atlanta. Professor White is a co-editor of the Econ Journal Watch and a member of the board of associate directors, or editors, of the Review of Austrian Economics. He is a distinguished senior fellow of the F.A. Hayek Program for Advanced Study in Philosophy, Politics, and Economics of the Mercatus Center at George Mason University, and a senior scholar of the Cato Institute Center for Monetary and Financial Alternatives. So, with all that, I'm looking forward to our conversation today. And like I do with all my guests, the first question is, what motivates you to do what you do each and every day?
One thing you left out from my bio is that I'm currently professor of economics at George Mason University. That's my main job. So I'm an academic economist, and what motivates me is trying to learn things about the world. In particular, my focus is on monetary institutions. So I've long been interested in the history of money, the different ways in which money has been supplied, either by markets or by governments. What are the characteristics of different monetary systems? And it's all led up to the new book you mentioned, which is How We Can Get Better Money, or Better Money is the title. So the three leading candidates are the current system we've got, fiat money, a gold standard, or a Bitcoin standard. So in the book, I try to explain what the differences are in the way they operate.
Yeah, and you do a great job of it as well. I read it recently. It's a great book. Hope the audience will go out and purchase a copy. And I think one thing I think will help the audience know kind of where you're coming from is what sort of schools of economics do you kind of adhere to, kind of follow, things of that nature?
Well, I don't first think about what a school thinks on a topic and then mold my opinion to that, but I have been influenced a lot by some Austrian economists, in particular Mises and Hayek, and I had the privilege of working with Israel Kirzner at New York University. And when I was in college, I first thought I wanted to be a lawyer, but I saw Kirzner speak at a conference, and everybody was paying rapt attention to his views on how the economy works. And I thought, that looks like a nice thing to do for a living, learn something and spread your what you know with an audience that, isn't up to speed. And so that was kind of the inspiration for instead going to graduate school in economics and getting a PhD and entering an academic career.
Yeah, that's great. And I think that's important to know, too, is that you don't adhere to just one school of economics. And others have said that, too. Kind of when I talked to Pete Boettke and others, they're like, yes, Austrian economics is an important one, but you also consider others, too. Public choice. There's a lot of good schools of economics that I hope others will look into and not just follow one.
I got my doctorate at UCLA in what we consider the heyday of the UCLA School of Economics. So an emphasis on property rights and the incentives they create and understanding markets in terms of law and economics and property rights.
Yeah. No, those are very important there. And as you've been going through and doing your research over time, publishing in some top academic journals, one of the key things that I really started following you on was on free banking. And maybe I want to get to that. But first, I think it would be important for the audience to understand, what is money? We talk about gold, fiat, Bitcoin, things of that nature. What exactly is money? How would you define it?
Well, the standard definition, which I'm happy with, is that money is a commonly accepted medium of exchange. So it's something you accept not in order to eat it or consume it or plant it in the ground, but in order to trade it away later for the stuff you do want to consume or invest. Right? So it's something you acquire in order to trade away later. And you can have an idiosyncratic medium of exchange that only you use, but if lots of people are using the same item as a medium of exchange, it's commonly accepted, then we call it a money.
And I guess other things that I've heard, in economics courses, people have probably heard of standard store of value, unit of account.
Right.
Do those matter as much as the medium of exchange?
Well, the unit of account is something that derives from money's role as a medium of exchange, as a commonly accepted medium of exchange. And I actually have an article on this topic, which basically makes the point that if you're selling goods, you will naturally post prices in terms of the stuff you actually want to be paid. So if you want to be paid in silver coins, you'll post the price in silver coins. And if somebody brings a sack of wheat to the counter and tries to pay with that, you'll say, no, I want to be paid in silver. Now, you could post the prices in wheat, and then when somebody brings the wheat, say, no, I want to be paid in silver. But then you're just imposing a burden on your customers to know what the exchange rate is between silver and wheat. In pathological situations where money is really bad, you sometimes do see that. People will, in a hyperinflating economy, post prices in US dollars, even though they accept payment in local currency. But outside of those kind of situations, people will post prices in what they want to be paid. So that makes the commonly accepted medium of exchange serve as a unit of account. Now, store of value is not something particular to money. And I'm frustrated that textbooks continue to list it because it just means an asset. A store of value is an asset, and there are lots of assets in the economy. To serve as money, something has to be an asset, it has to have value, but that doesn't distinguish money from real estate or jewels or anything else.
Yeah, that's well put, and I agree with you. I remember teaching the course, and you see that in the textbook, store of value. Yeah. I would talk about it briefly, but then I would just kind of skip it and go back to the medium of exchange and how it builds the unit of account. And and historically, currency. So I guess we start off with the barter economy, where we're trading goods or goods and services, things of that nature, build our comparative advantages and the extent of the market, things that Adam Smith had talked about in The Wealth of Nations in 1776. And currency kind of evolved over time as a way to reduce some of those transaction costs along the way, right?
Exactly. So Smith understood that money was, in his day, gold and silver were money by the consent of the market. And he hinted at it, but he didn't really give a full explanation of how it had evolved. I think a really satisfying explanation finally comes with Karl Menger, who's the founder of the Austrian school, who explains that in a situation where people are coming to market and trying to trade, they're going to meet frustration finding somebody who has what they want and is willing to be paid in what they're coming to market with. So it pays to trade what you've got for anything that's more likely to be accepted by sellers. So people are on the lookout for what's commonly accepted just for consumption purposes, and those items tend to become widely accepted media of exchange. So the market converges, Menger explained, because people are on the lookout for what will be readily acceptable to other people. And so they're more ready to be paid in that than in something that very few people want. So we get a kind of convergence effect that elevates some commodity to the role of money. And historically, lots of things have served as money, shells, barley, but it was gold and silver once they became coined, once the technology of coinage developed to make uniform pieces possible, that drove all the other commodity monies out of the market.
And even in, I think it was in Germany, right? You had you had cigarettes that were made for smaller transactions.
So when you have a hyperinflation like in Germany in the 20s, the money becomes so costly to hold, the value's melting away so fast that people go back to barter if they don't have another alternative. And so, yes, in prisoner of war camps, you got cigarettes serving as a commonly accepted medium of exchange because it was the best thing available to play that role.
Right. Yeah. It's quite fascinating to kind of read some of that history and what was going on at those times. And so whenever we're thinking historically, to your point about shells or gold or silver, these types of commodities have some sort of, especially gold and silver, have an intrinsic value. And I think maybe the next point here might be for us to talk a little bit about what's so important about gold and silver versus a fiat currency, or maybe you want to start with fiat currency. Kind of in your book, the way you laid it out was fiat and then gold and then get into Bitcoin. How would you like to explain that progression?
Yeah, so I wouldn't like to use the phrase intrinsic value. That suggests that it's in the object rather than in the minds of the people who are valuing it. But commodity money has a value in a non-monetary role as well as in a monetary role. So that's the difference. Whereas fiat money, the kind of money we have today, you could call intrinsically useless. It doesn't have any other function other than serving as money. The virtue of a commodity money is that the production of it can be decentralized and left to competitive market forces. So gold and silver can be mined many places in the world and can be minted many places in the world. I have a recent paper about private gold mints in the United States during the gold rushes. There were 3 different gold rushes, and one in Southern Appalachians, the famous one in California, and then a later one in Colorado. And in all 3 cases, private mints arose to make coins out of the nuggets and gold dust that was coming out from the miners, because it's so much more convenient to use coins than some bag of loose gold dust where nobody knows what the purity is. So what the mint does is certify the purity and the weight of the piece of gold that you're using. And so that's a service that can be provided in markets. So the virtue of a commodity standard is that you don't have to rely on some expert committee the way we do with the dollar today, where we rely on the wisdom of the Federal Open Market Committee, which is part of the Federal Reserve System, to make the right decisions. So the decisions are all in one place. There's a single point of failure. And when they get it wrong, the entire money supply is out of whack. And we've been having problems of that sort in recent years. Right? Last year, inflation peaked at close to 9% in the U.S.
Yeah, no, that's right. It's come down a little bit to around 5%, but it's still elevated. And we've seen a lot of inflation over time as well. And I think going back to the gold standard, and you're thinking more about the 19th century, there was a period of free banking for a while. We had a period of a bimetallic standard between silver and gold that Friedman has written a lot about, and things of that nature. What do you like so much about the free banking system? Because I know you've written about it a lot, and I've heard you speak about it several times. What do you think is so important about a free banking system?
So my doctoral dissertation and my first book were about the free banking system in Scotland and the debate over whether to adopt that system in England or instead to fortify the central banking powers of the Bank of England. And of course, the Bank of England side won in the Parliament. But what I found, so when I talk about free banking, it means unregulated banking. What happened in the U.S. under the label free banking wasn't exactly laissez-faire banking. It was still heavily regulated. It was operating under state laws. And it was different from the preceding system only in that anybody could get a bank charter if they satisfied the requirements. But there were requirements. In particular, you had to have a certain minimum capital. But the requirement that caused problems was you had to hold state government bonds as backing for your banknotes. And if the state government bonds fell in value, then banks were wiped out. So it was not a well-diversified system. And of course, in the U.S. in that period, we had no interstate branching. Banks were limited to a single state, and in many states they were limited to a single office, so-called unit banking. So the U.S. banking system has long been much more fragile than banking systems around the world. So what people found surprising about the Scottish system was that it was competitive, it was decentralized, and it was very stable. There weren't a lot of bank failures, and badly run banks would fail, but there wasn't a contagion effect. There wasn't any system-wide panic because the other banks were established on their own reputations and were pursuing their own strategies. So that people found surprising. And a lot of American economists only know a little about American history and nothing about the history of banking in the rest of the world. And so they infer that banking is inherently fragile. And that's a mistake. That's based on taking this unrepresentative sample. People have lately been using this unrepresentative sample, the U.S. in the early 19th century, to say, oh, when you have competition in money issue, it creates all kinds of instability, and chaos. So people have argued against stable coins on that ground. No, we need to regulate it. We've learned from history. You're drawing the wrong lesson from history if that's what you've learned. You're generalizing from an unrepresentative sample of a fragile banking system. But banking is not inherently fragile if you don't restrict banks' ability to be well capitalized and to be well diversified.
Yeah. Yeah. And with free banking, is it essentially where private banks can issue their own currency? And then that way there's competitive. Yeah.
Yeah. So that was the distinctive characteristic in the 19th century, because about half or more of bank liabilities were in the form of currency, that is banknotes. So these circulating claims that were IOUs issued by a bank, but went from hand to hand. So unlike a check, which you have to sign over and has to go back to the bank to be cleared and settled, banknotes just circulate the way paper currency does today. And that was, like I said, about half of bank liabilities. So that was an important way that bank lending was funded, by getting people to hold your banknotes. And so banks competed for customers in the banknote market by trying to establish their trustworthiness, their stability, by arranging with other banks that the banknotes would be accepted at 100 cents on the dollar at face value. In the US, the banks weren't able to do that because of the legal restrictions on them. So you had banknotes that circulated at various discounts, and it was a hassle for everybody. But outside the US, you don't find that. You find banks allowed to branch nationwide. Like in Canada, the banknotes circulate nationwide at full par value. You don't have a problem of volatility of banknotes. And that's what we should expect from stable coins, not volatility.
Yeah. And so there was this period of, free banking here with some issues with the regulations that were in place on the banks and things of that nature. We also had this bimetallic standard for a little while. What are your thoughts about that, where we had gold and silver that was backing, the currency?
So bimetallism, as far as I can tell, has never been a market emergent phenomenon. It's always been imposed by legal restrictions, that where the mint tries to put an official value both on gold and on silver. And that's okay as long as the official exchange rate between silver and gold is equal to the world exchange rate, in the exchange rate in the world market. But when they get out of line, say the world market rate changes and the bimetallic ratio doesn't change, then you have a problem. You can either pay in gold or silver, but one of them is worth more on the world market than it's worth at home at the official exchange rate. You're going to pay in the less valuable money. And so the bad money is going to drive out the good money. That's Gresham's law. So bimetallism can become, in practice, monometallism. And the legally overvalued money is the one that's going to prevail. And the undervalued money people will hoard or export or melt down. And you get a shortage of silver coins if it's silver that's the undervalued metal. And so it was a problem. The problem was eventually solved by banknotes. So once you have banknotes, you don't need silver to have small denomination currency. And the US de facto was on a monometallic gold standard through after 1828, I think was the year they set a ratio that overvalued gold. But officially there was bimetallism, and there was agitation to coin more silver, mostly coming from silver mining states, and by inflationists who realized that it would drive down the value of the dollar. So farmers who were indebted wanted to cheapen the dollar so they could pay back their loans more easily. But in 1900, the U.S. passed the Gold Standard Act, which said, no, we're not going to coin silver anymore in unlimited quantities. We're on a monometallic gold standard. And that's a more sensible solution.
Yeah, that makes sense. And then soon thereafter, we had the banking panic was in 1907. And then we had the Aldrich Commission come in and said, put in place, here's what we need to move forward. And then the Federal Reserve Act was passed in 1913, which is, by the way, also when the income tax was put in place as well. And then started the Federal Reserve as a central bank of the United States. And then that kind of started our fiat currency system. To some extent.
So there are many intermediate steps, but that's basically right. We got a central bank in the U.S. not because we needed it to control the quantity of money. The gold standard was doing that, but because we had a very weak banking system. We had financial panics because the restrictions on the banks made them unable to meet the public's demand for currency during peak demand for currency seasons, crop moving seasons, they called it. And there was several panics, but 1907 was the worst. And before 1907, there had been a movement for deregulation of note issue to make the U.S. system more like the Canadian system, which people noticed wasn't having panics. So why don't we be more like them? Allow banks to branch nationwide in order to collect their own notes that are excess out of circulation and have par circulation of notes. But the small banks didn't like that approach. They didn't want large banks branching into their neighborhoods. So in a way, we got the Federal Reserve Act to preserve a system with weak local banks. And the small banks have been a very powerful lobby throughout U.S. history. It wasn't until the 1990s that we get interstate branching.
Wow. No, this is great history to talk about these things. And, whenever the Federal Reserve, 1913, you had in the 1930s during the Great Depression where FDR basically took us off the gold standard to some extent.
With the connivance of the Congress.
Yep. Yeah, there you go.
But when the Federal Reserve is founded, it's on a gold standard. It's assumed that the gold standard will continue to prevail, and the Fed is not given the job of running a monetary policy. No. They're basically a standby in case there's a panic. Then they provide more reserves and more currency to meet the demand for it.
It was a lender of last resort, right?
That's exactly right. So that was the original role of it. But in the 30s, they took the right of note issue away from commercial banks, and that made it possible for the Fed to say, since now it's the only issuer of currency, we're going to stop redeeming it, and there's no alternative. People are stuck with Federal Reserve notes. And so that's the beginning of the fiat currency. So there are two steps. One, FDR, as you said, empowered by Congress to do so, ends domestic redeemability of Federal Reserve notes. But the dollar is still redeemable for foreign central banks at $35 an ounce under the Bretton Woods system, which ends in 1971 when Nixon closes the gold window and says we're not going to redeem for foreign central banks. So it's only since 71 that we've had a pure fiat standard, completely divorced from gold.
And we've seen some major disruption throughout the monetary system, throughout with inflation, throughout the economy, the orders of production. If you think about it from an Austrian perspective, the boom and bust cycles that go on.
Right.
And so I think what I really liked about the book, though, is how you put it all in this historical context, broke it down into some basic economics where I think anyone in the audience could read it and understand it. I don't think there's any equations. There's a couple of charts.
Some supply and demand diagrams, but very few equations.
Yeah, but easy ones to see.
Right.
And I think in our last maybe 10 minutes that we have here, I'd like to get into kind of the divide now between, and maybe it's not really a divide, but maybe the competition between fiat, gold, and Bitcoin. And starting with that, if you could, maybe for the audiences, give a little bit of a description about Bitcoin and a cryptocurrency just in general for those who may not know too much about it.
Okay, so the point I wanted to make about the contrast between a gold standard and a fiat standard is a gold standard, the quantity of money is self-regulating. It's regulated by market forces. Under a fiat standard, as I said, we rely on the wisdom of the committee that's appointed to decide on monetary policy. They meet every 6 weeks and change their minds. And that introduces a fair amount of uncertainty into the market. People have to try to guess what they're going to do next. Now, a Bitcoin standard or Bitcoin is engineered a different way. And it's fascinating because it's a money that arises or arose in the marketplace, and nobody's ever been compelled to accept it. But it kind of lifted itself by its own bootstraps into having a positive value. And Bitcoin, unlike a banknote, which promises to be redeemable in gold coin, Bitcoin is not redeemable for anything else. It's not pegged to anything else. Its value is the value that people are willing to assign to it. And the original vision of the founder, who went by the pseudonym Satoshi Nakamoto, Nakamoto's original idea was that this could be a world currency to replace fiat currencies. And he wrote about how we've learned that we can't trust central banks to provide us with the trustworthy money. They've betrayed that trust many times. However, what I argue in the book is that the supply mechanism that he engineered for Bitcoin is that we know at any moment how many Bitcoin are in circulation. There's a fixed release schedule, and it's designed to max out at 21 million Bitcoins. We're currently at about close between 19 and 20 million. So most of the Bitcoin that's ever going to be issued has been issued. But because of that, the supply is completely inelastic, or in econ jargon, the supply curve is vertical. The quantity doesn't respond to anything that's happening in the economy. There's no feedback. So that means the value is going to jump around. When there are changes in demand, it's all going to be reflected in the price because the quantity is not going to respond. By contrast to ordinary goods, when there's a big increase in demand, the price goes up, but that incentivizes suppliers to supply more, so the price comes back down. In Bitcoin, there's nothing that makes it come back down to any value that's influenced by the cost of production. The cost of production is completely endogenous, I should say, it's a technical term, is determined by the value of Bitcoin and not the other way around. So that means the value of Bitcoin is very volatile. And if you look at charts that show the volatility, how much the price changes each day or each month, it's many times more volatile than the price of gold or the price of euros in US dollars. It's even more volatile than the S&P 500. So for that reason, I think it's not likely to be a popular medium of exchange. It's very risky to hold your rent money in Bitcoin. It could drop 7% tomorrow and you're going to have trouble meeting your rent. Now, it does have some valuable uses, namely that you can send people value without going through central banks. So if you want to support, this is an example given by a writer named Alex Gladstein. If you want to support dissidents in Belarus who are, trying to liberalize the economy and escape from the Soviet-dominated government, you can't wire them dollars. It won't get there. The Belarusian government controls the central bank, and they won't allow dissidents to have bank accounts, but you can send them Bitcoin. So it's a way to send money that escapes the censorship of central banking systems, which, central banks have become increasingly political. They've been kind of roped into this service by governments of censoring payments, right? So Russians cannot have bank accounts in dollars anymore. We're not processing payments, even for innocent Russian citizens. We have this blanket embargo, which, is a pretty blunt instrument.
Yeah, no, and one thing too about Bitcoin, I guess, is the blockchain. The technology that's there, I think, also has a lot of things that it could do in the future. Implications for the future as well that I think will be helpful in many ways. And there's a lot of talk now about a central bank digital currency. And I wonder what your thoughts are on that.
Well, a central bank digital currency is a proposal to have the Federal Reserve System provide a retail means of payment. Mm-hmm. So up till now, the Fed has specialized in wholesale payments. They allow banks to pay other banks through the FedWire system. For the Fed to take on retail payments, the most common proposal, there are kind of two models. The most common one is everybody can have a bank account on the books of the Federal Reserve System, and then we can transfer them to each other instantly and frictionlessly. The problem is the Fed has no experience in retail payments. There's no reason to think they would be efficient at it. It's like asking the post office to take over retail payments. The Fed has about 20,000 employees. The number of bank tellers in the U.S. is over 400,000 people. So for the Fed to take over all the retail accounts would be a massive undertaking, and there's no reason to nationalize that industry. If you want fast cell phone payments, we've got that. We've got Venmo. We've got Cash App. The move for a central bank digital currency just seems to be a kind of fear of missing out on the part of the Fed. They don't want payments that they don't directly control.
Yeah. I mean, and in many ways, they've devalued, of course, the dollar, kind of screwed up that whole system. Why would we want them to go and screw up another system with Bitcoin or something else?
Besides the inefficiency of it, there's a real danger that central bank digital currency can be used for surveillance. Mm-hmm. Which is exactly why the Chinese government has introduced it, so that they know what's in your account and who you're transferring it to, and they can stop you. If you don't have enough social credit, if your score is too low, well, you can't buy a train ticket. Sorry.
Yep.
So that's a danger. And frightens me when people say we need to emulate China. They're out ahead of us on this technology. We don't want a surveillance technology.
No, we certainly don't. I don't think that a central bank digital currency is a good idea. I hope we don't go in that direction for the reasons you laid out there so well. One of the last thing here to kind of talk about would be there's some talk about the de-dollarization that's going on globally. And, you see OPEC, some of them not exchanging in dollars for oil. You see China and others trying to get off of using the dollar. They're not purchasing as many of our treasury securities, for one thing, and
Right.
what sort of implications that might mean for the United States economy. But could that also help us to get back to something like the gold standard or something else based on that's not the fiat system that we have today?
That's a good question. I mean, we should expect people to want to move away from the dollar after we have a year of 9% inflation. Well, the whole year wasn't quite 9, but that's where it peaked. So the dollar has this tremendous incumbency advantage. It is the most commonly accepted medium of exchange on the planet. And that is a kind of self-reinforcing thing. Everybody wants to be paid in the money that's easiest to spend, and that's the dollar. But to keep that status, you have to keep the dollar trustworthy. You have to keep inflation low and steady and not bouncing around a lot. That will make people look for another currency that's more trustworthy. The euro has disqualified itself. They've got 10% inflation. British pound, 10% inflation. But Swiss franc never got above 3.5, and the yen. So I don't think the Chinese yuan is really a candidate here because China has a very closed financial system. They don't allow people to transfer money in and out freely. They insist on controlling and rationing and surveilling. So I don't see any real threat from the yuan. But in order to keep its preeminent status, the dollar has to be managed better. We have to keep inflation lower. So that leads toward having a more responsible fiat monetary policy. If they prove themselves incapable of that, I hope they don't, but if they do, then a gold standard is waiting in the wings, right? But it would take congressional action to move us back onto a gold standard. It's hard to imagine getting enough votes until the dollar is really performing badly. So in a way, I hope that we don't have spontaneous reemergence of the gold standard, because that would be a symptom that things have gone very badly. But if people understand that the dollar system is riskier, the fiat dollar is riskier than a commodity standard, it's possible to imagine Congress deciding to put us back on a gold standard. Not very likely in the immediate future, but it's good to have, plan B on the shelf in case plan A breaks up.
Yeah, that's right. And I think we're seeing some of the implications right now of Congress running up massive deficits and the debt hitting a debt ceiling. We're seeing interest rates soar and the implications that's having for mortgage rates and everything else across the economy as things slow down. Today, we're recording this on April 27th. GDP in the first quarter was only 1.1%. So a lot of slow growth that's out there as well. And the Fed probably will continue to raise interest rates. I mean, I've been arguing, I think that they should. I know there's some folks who say maybe they should pause given some of the banking crisis issues that's going on, but I think that many of these banks are going to fail. We were propped up over the last couple of years on a lot of government spending, a lot of increase in the balance sheet by the Fed from $4 trillion to $9 trillion. They've went down a little bit. Money supply, M2 is down, a little bit year over year. But we had a massive increase of
still above where it was before the pandemic.
Right. And so I think these are kind of the boom and bust cycles that I think the Austrian perspective has been able to explain. Austrian business cycle theory has explained so well that, sometimes you say, okay, the recession's coming, but there are other things that are going on throughout the distortions in each one of these markets that start to play out that have to clear at some point. And I think this is going to continue to clear and have a pretty large effect on the overall economy as this starts to play out. Is that kind of what you're seeing, or are you seeing something different?
Yeah, no, that's right. So at the beginning of the pandemic, the Fed injected a lot of money, and that was actually an appropriate thing to do given that people were sitting home not spending. So it kept nominal GDP from falling as much as it would have. But then as the pandemic started to fade and people went back to spending, or to put it in jargon, the velocity of money rose back toward normal, the Fed failed to withdraw the extra money they had injected. So we didn't get inflation right away, but we got it last year because of this overhang of money they injected that they failed to pull out promptly enough. But the fiscal situation is worrying because one of the dangers to the stability of the fiat dollar is that the Fed is pressured into monetizing a large share of the debt that the Treasury is generating. Even in peacetime, they're generating these huge deficits. So we have to get that under control to reduce the pressure on the Fed to print money.
Yep, that's exactly right. Well, Larry, it's been a great conversation today. I think the audience will have learned a lot about money, about the different types of standards that are out there. And kind of closing, what else would you like for the audience to know, or about the book, or anything else that's going on that you'd like to share?
Well, the book's available in Kindle as well as hardback and paperback. You can find it on Amazon. The full title is Better Money: Gold, Fiat, or Bitcoin ? So I think the more informed we are about monetary alternatives, I hope the more strict people will apply standards to the behavior of the Federal Reserve System and put it under the kind of scrutiny it ought to be under and hold it to better performance than it's been doing lately.
Yeah, I agree with you. And are you in favor of like a monetary rule of some kind?
Well, I'm in favor of a very strict monetary rule that says we don't have a central bank and we have a commodity standard and free banking.
Amen. I
but
agree.
as long as we have a central bank on a fiat standard, then yeah, I think anything that made its behavior more predictable would be an improvement. So among rules, I'm sympathetic to a nominal GDP target.
Gotcha. Sounds good. Well, this has been fascinating. I hope the audience learned a lot. Thank you for being here today and for all the work that you do. And God bless you and your family. And so thank you for being on the show, Larry.
Thanks for having me. Enjoy it.
You're welcome. For the audience, hopefully you enjoyed this discussion. If you did, please leave us a 5-star rating and share this with your friends and family. And until next time, have a prosperous day. Thank you.